Hi everyone, welcome back to Limitless Trading. I'm Jonathan and this is Terry.
Hi guys!
We are starting our series on options. It's an educational series that we are using to bring us both up to speed on where we are financially speaking from our investing and trading experiences. A little background, I have a few years of experience trading options. Terry does not yet have any experience, and we are going to change that. But today we're going to start with what options are. We learned in our intro, feel free to go check that out right now. We learned that Terry is new to options, and that's where we're going to start. So today we're going to talk about what options are and what they're not. So let's start with what the basics of options are. Options are contracts. Mm-hmm. It's basically a piece of paper. Mm-hmm. Every time I sell an option or buy an option, it is created or destroyed. Mm-hmm. Options exist between buyers and sellers. Mm-hmm. So it's a contract between two parties to do something.
Who is the other party?
The other party with options, it's generally a market maker. These are large quantitative funds that are buying and selling options and using stock to hedge their positions. Simplex would be one example. Citadel is another example. There are many other. Susquehanna. You can go look on the internet, look for option market makers, and you can find a complete list.
What I mean is, you sign a contract with whom?
Yeah, with a market maker.
Okay.
So I sign a contract saying I will do this, and they sign a contract saying they will do this, and then we agree on a price, and that's that. Mm-hmm. So with them being contracts, they don't just naturally exist. They have to be created when a price is agreed upon. One other thing, or there are many other things about options, but the next thing that I have in mind is that they have an expiration. Options generally expire on the Saturday after the third Friday of every month. What that means is they can only be traded until the close of markets on the third Friday of every month. Different countries have different rules on this. I don't know all of the rules and standard practices. I know enough about the US markets and European markets that it is the third Friday of every month. I know in other markets, for example Hong Kong, they might use different expiration days.
Mm-hmm. So for each contract there is an expiration day?
Yes. Some underlines have expirations every month, so there's only one expiration a month. Some underlines have daily expirations. For example, the SPX has, I believe they have Monday, Wednesday, Friday expirations. They might also have Tuesday and Thursday. I don't trade SPX just from a size standpoint, so I'm not that familiar with SPX. Options have an expiration, and upon this expiration, there is a delivery or a settlement or an assignment. What that means is the expiration date, something happens. If options are in the money and they expire, then they're either cash settled or shares of stock or an underlying or whatever is transferred from buyer to seller or seller to buyer. Okay. All the options that expire out of the money, you don't need to concern what out of the money and in the money mean right now, but all of the options that expire out of the money are worthless at expiration and no transfer. There are rights and obligations because it's a contract and all contracts have rights and obligations. Buyers have the right, but they don't have the obligation to do something. Sellers have the obligation to do whatever they committed to. So if you're engaging in options, buyers always have more flexibility. And the way option pricings work, they pay for this flexibility. There are two different types of options. You have calls and puts. A call is a contract between a buyer and a seller where the buyer specifies a price at which they want to purchase something and they pay a fee to do it. A less abstract example would be a house. If you're shopping for a home, you go out and you look and you look and look and eventually you find one and you love it and you say, I'm willing to put down 5% right now to guarantee my right to buy this. And that usually buys you, 30 days, we'll say.
So it's like a reserve fee?
Yeah, you can call it a reserve fee. And it is, it means you pay this, you never get it back.
Down payment.
Yeah, sort of like a down payment, but with options, it doesn't count towards the price. Yeah, so that's what a call is. Buyer of a call says, I want to buy something at this price in the future. And the seller says, well, okay, I'm fine with that. You had to pay me a little bit of premium in order to make this appealing to me. Puts are a bit different. A buyer of a put, the real world example, sticking with real estate and homes, is after you bought that home, then you want to insure it just in case it burns down, or a hurricane comes by and knocks it down. You want to make sure you have insurance in place. That way, if the price goes down, meaning the building falls down and it's no longer worth anything, you can get some value out of it. So if you're a buyer of a put, what you're basically saying is, I want to ensure that I am covered if the price goes down. And if you're a seller, you're an insurance company saying, I don't think the price is going down. So I'm fine, I'll insure that for you.
A little bit confusing, but I hope we could have a example so that I can understand better.
Yeah, we'll definitely jump into examples. You want an example? Should we talk about an example right now? All right. So let's be buyers of calls and buyers of puts with housing. You and I, we're looking for a home. We're gonna go out and we're probably gonna, because the market's so hot right now, we're gonna look at 100 different places. All sorts of fun, right?
Yes.
Yeah.
For me.
Yes, you do love
shopping
yes. For a good deal. So when we find the home that we want, we're going to put down a down payment so that we can secure our opportunity to buy it. Then we'll get our financing in place and we'll complete the sale.
Yes.
And now we got all of our furniture in, we've got all of our new walls painted, everything is nice and clean and perfect and pristine. And we're going to go to an insurance company, we're going to say, our new home is worth such and such. We want to make sure if anything happens, we get this much in order to replace it. We want to make it new again. We don't want to, insure it for something less than what it is. So we're going to go out and we're going to buy insurance. What the insurance basically says is, in the event that something happens, you will get money to bring it back to this state. If the home burns down, then we'll get a full cost to rebuild. If maybe some minor damage happens, we'll only get the cost for this. So we can think of the put option in the same sense. If we buy a put, what we're saying is, in the event that the market crashes, we don't want to lose money. And in order for this to happen, we're going to pay regular insurance premiums because we don't know when something will happen. We don't even know if something will happen, but we don't want to take the big risk. We're willing to pay regular insurance premiums in order to reduce our risk. And if nothing happens, then we paid the insurance premium, we bought our puts, nothing happened, they expire worthless. If something does happen, the increased value of the puts will offset the losses on our stocks or assets.
So who is this insurance company?
It's just another party in the market. You can think of it as the market.
It's also a person out there.
You can think of it as the market itself. The market is the conglomerate, is the accumulation of everybody who is not you and me. Why? Because they don't think anything bad is going to happen.
Yes, that's why they dare to sell this insurance to us.
Yeah, they just say statistically over time, nothing bad is going to happen. People sell puts when they think the underlying is going to stay flat or go up. So right now, an insurance company isn't concerned, they'll write a contract right now because the value of everything's going up.
Yeah.
This is where the insurance contracts start to lose a little bit of its validity for this example. But with equity or index or whatever options, put sellers will sell because they think it's going to go flat or up.
Oh, okay.
Both, so that's two chances to be right. Put buyers buy because they're afraid it's going down.
So this put seller, they make money from the price difference between the higher price and the insurance price?
They collect the premium,
What is the premium?
the price of the option. How much we agree for this insurance.
Oh, okay. It has nothing to do with the price of the stock.
It is related to, it is not based on.
Okay, how much is the premium?
It is whatever it is agreed to. So as fear goes up, premiums go up. As fear goes down, premiums go down.
Generally,
In
percentage?
2019, in 2020 in January and February, premiums were about as low as they can possibly go. In April of 2020, when the world was on fire, so to speak, premiums were as high as I've ever seen.
Because
Fear determines how big premiums are.
Because they estimated the market will go down?
Fear.
Okay.
Unknown.
Can you give me an example, like how much is the premium normally cost?
There's no normal. It's whatever is agreed to.
Okay. Yeah, continue. Yeah. It's okay. I think I'll understand it better later.
Options are all based on underlyings. I mentioned one earlier, SPX. Apple's an underlying. Gold futures are underlying. There are an unlimited number of underlyings in the world. Underlying just means the stock or whatever this is based on. When we look at real world examples, the underlying is the house that we want to buy, the house that we bought, the house that we want to insure. That is the underlying. The price we pay for the call and the price we paid for the put, so the down payment we put down and the insurance we buy, these are based on the underlying and related to its value. So without the house that we're going to buy, there is no option. Pricing, I believe this is what you're really interested in, right? You like pricing. You like to find a good deal, right?
Yeah.
Yeah. Okay. So pricing is based on the Black-Scholes model.
Black what?
Black-Scholes. They are two, I believe they're economists. If I'm wrong, please leave a comment down below. They might have been mathematicians.
Oh, that's a person's name.
Two names, Black and Scholes.
Okay.
They are the two individuals that put together the model. Went on to work, I believe, both of them in long-term capital management. They came up with a model with a lot of Greek symbols, and through these Greek symbols, one can determine what the price is. That's the theory. In reality, the price is determined by the market, and all of these Greeks are derived from the price. We'll start going into them, but I'll just give you a little heads up. Delta, gamma, vega, theta.
I know. I learned mathematics before.
And do you know what they mean?
No.
Okay, exactly. Exactly, so that's pricing. It's probably for you it's going to be the most fun. Unfortunately, it's also the one at the very end probably, because you have to understand all the constructs before we can get there. But we're on our way. It'll be a fun trip. Once again, guys, we talked a little bit today about what options are and what they are not. There are contracts between buyers and sellers. They expire, they don't live forever. It is not like a stock that lives forever as long as the company stays alive. They have requirements for delivery or settlement, and they have rights and obligations, meaning somebody agrees to do something and somebody must do something else. We have calls and put options. If you're familiar with GameStop, then you're probably familiar with call options, and they are all based on underlyings, and their price is, it looks complicated, but it's really fairly simple to figure out. We're talking about all of this because we want to make sure that we both have the same understanding of the financial situation that we're in and the financial investment and trading strategies that we use. We think it's just very important for us both to understand that. We're glad all you were with us here today, and we hope you'll stop by next time as we move deeper into options and start talking about more detailed topics. We hope you all liked our topic for today, understanding options. We hope you come back next time when we start talking about why people would use options. Once again, thanks for stopping by Limitless Trading. I'm Jonathan.
I'm Terry.
We'll see you soon.
Yes. See you next time. Bye bye.